Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
His friends call him Mikey, and I'm his friend. I'm calling him Mikey. Mikey Shah, Michael Shah, Senior Pharma-Biotech Analyst at Bloomberg Intelligence. He's based in London. Mikey, you got to talk to me about what's going on with Novo Nordisk. I thought these obesity drugs were the bomb here. What's going on with their guidance? That was a huge miss for them.
Yeah, two pieces of news today. First is the guidance cut, so second guidance cut of the year. So reported guidance now is calling for 7% sales growth, 6% operating profit growth after adjusting for currency, and that compares to 14 and 15% respectively previously. Now, a lot of that is related to the US market. They're still seeing headwinds from compound and GLP-1, which seems to be the main driver. That's affecting Wegovy growth. And there's a lack of visibility here. So all of that creates uncertainty for investors and also kind of questions around not only 2025 numbers, but the exit rate into 26. So there's concerns about, mid to long-term growth, given how concentrated or how reliant, Novo is on Wegovy for growth. The other headwind is competition to Ozempic. So that's the GLP-1 for diabetes, and that's another, key growth driver for the company. Second piece of news, new CEO appointment. So they went with an internal candidate. I think the market was perhaps expecting them to go for an external candidate. So, perhaps a bit of disappointment there. But that said, he's been at the company. So this is Mike Doustdar. He's been at the company since '92. He's been heading up international operations since 2016. And over that time, we've seen international operations sales double to around $18 billion. So, he's an internal hire. He's familiar with the company culture. I think it's a bit too early to write him off before he's even started. Now, his focus is going to be on regaining ground to Lilly in the obesity space, maintaining leadership in the diabetes space, and then improving execution. And that's something that's going to be key ahead of the CagriSema launch, as well as the launch for its oral GLP-1 in obesity. Particularly given, CagriSema perhaps isn't as differentiated as we had hoped for, and then the oral GLP-1 profile perhaps trails that of Lilly's.
In a call with journalists, though, the new CEO said he's planning to review the company's cost base without setting specific targets and metrics. So could this indicate that Novo is preparing for a period of slower growth after the initial surge in demand of especially the blockbuster Wegovy drug?
I think it'll be hard to slash R&D, to be honest. And they would need to, continue marketing, continue to do DTC, in order to, in order to compete with Lilly. They're obviously heavily investing into CapEx at the moment, but there is probably some operating leverage in there, to provide some sort of relief. I mean, the company's got a margin of about 45%, which is at the top end for large pharma.
Hey, Mikey, is there any reason to believe that maybe the marketplace has been overestimating the size of this obesity drug market?
I think there's always a risk with an indication this size. When you look at the market potential, in the US alone, it's 140 million patients, which is the target population.
I think that's one-third of our population, man.
Yeah, there is a risk that, perhaps consensus did get ahead of itself. But the difficulty here is, you have, huge runway of patients. There's obviously limited supply. So it's difficult to know kind of, how quickly that supply can come on board. Now, Novo gives guidance around, their growth prospects, where they think sales, et cetera, are going to go, but they keep, they don't necessarily quantify, the cadence of supply and how quickly that's going to come online. So that kind of makes forecasting quite difficult. And obviously they don't want to give that information because it's competitive information, and they don't want, Lilly to know about it either. So.
Boy, back in my analyst days, I would have slammed at this management team because that guidance was brutal. They were nowhere close to hitting it, and their big reduction in the guidance, and we see the stock down 22% today. down 37% year to date, 52-week low. So they're paying the price for it. Mikey Shah, folks, he's one of the best healthcare pharma analysts in the city of London. Every institutional investor wants to talk to him. We appreciate getting a few minutes of his time. Mikey Shah, Senior Pharma-Biotech Analyst, Bloomberg Intelligence over there in our London studios.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of my very first jobs on Wall Street back in the late 80s, I was a research assistant in the equity research department of Payne, covering the railroad and trucking industry. So I love the railroads. And today's a big deal. Union Pacific agrees to acquire Norfolk Southern for $72 billion. Now, the per share, it's cash and stock, works out to like $320. Yet Norfolk Southern is trading at a 13% discount, $279 is where it's trading today. It's actually down $7 today. I don't know what's going on out there. I'm not doing this stuff for a living anymore. But Lee Klaskow is. He's a senior transport, logistics, and shipping analyst for Bloomberg Intelligence. Lee, I look at the stock price of Norfolk Southern, and it tells me a hefty level of skepticism out there in the marketplace that this just mega deal can actually get done. How do you view it?
Yeah, I think the whole speculation before the deal was formally announced about a possible consolidation, really fueled shares of Norfolk Southern previously. And I think people are just trying to take maybe a breather right now because there are some execution risks, right? This deal is not going to close, if it does close, until early 2027. It needs regulatory approval, which is not an easy thing to do. There were certain rules that were created at the Surface Transportation Board to make it very difficult for large Class 1 rail mergers to happen. That was because at one time in the 80s and 90s, those sorts of deals resulted in terrible service. I think that the rails today were much more cognizant of service as it relates to integration. And I don't really think, either company, once assuming a merger does happen, are going scorched earth in terms of, what they're going to do to their networks. They mentioned on the call that they had earlier today that they're really not going to lay off any, frontline workers. Most of the probably layoffs are going to happen, in the offices. So, that would just mean that services would prevail. And one of the reasons why they are doing this, from an outsider looking in, it does make complete sense. You're going to reduce interchanges. They mentioned on their call this morning that between the two of them, they interchange around 1 million carloads a day. And if they're just able to, if that carload is able to be on the same network, it's not only going to improve network fluidity, it'll actually lower the railroads, their costs. Let's hope they pass on some of that cost savings to their shippers. I think that's what shippers might be concerned about. And it'll provide probably a better service product that they can go out and compete against other modes such as trucks. And, that's, also a good thing because, from an environmental standpoint, railroads are less fuel efficient. Trucking kind of deals with, turnover issues and trucker availability issues. Right now, that's not an issue, but at times it can be. And so, it is definitely a very interesting deal. It will create the first transcontinental railroad. But, they do have their work cut out for them to get that regulatory approval.
So the deal is worth $85 billion. How do they plan to make money back? What are the financial wins, so to speak, to justify that hefty price tag?
Yeah, they laid out $2.75 billion in synergies. About 1.75 of that 2.75 is going to be from revenue. So what they're saying is that, we can probably get more volume onto the network because it all of a sudden becomes a much more compelling service offering. And then about $1 billion in cost savings. And some of that, again, you don't need two CEOs, you don't need two CFOs, you don't need two corporate headquarters. They mentioned they are going to have their headquarters in Omaha, where Union Pacific is located, and keep I think they worded a major presence in Atlanta, where Norfolk is currently. But obviously they're not going to need as much space as they once have. And then there's technology benefits, so you're only investing, money in technology once, not twice, to get those productivity improvements. So I think those are the major aspects of it. And, they mentioned that, they could be, EPS accretive after year 2.
Lee, he mentioned a lot of regulatory agencies are going to weigh in here on this deal. I also think President Trump is likely to weigh in. Do we know anything about how he might view this deal or just consolidation in general? What's the view as to the Trump administration?
I mean, we don't. The language that management noted on the call is like they wouldn't have moved forward with this transaction if they felt that it was impossible to get regulatory approval. So whether that means they were talking to the administration, whether that means they were talking to the STB or the DOJ or everybody in between, that's kind of, if you read between the lines, is what they were saying. The fact that they're not going to lay off any union folks is probably a net positive for President Donald Trump to say, this is okay with me. So there's a lot of unknowns still. And again, this is going to take a long time. So we have a deal. It has to get Surface Transportation Board approval, which won't happen at least for a year and a half.
Could this spark more railroad mergers in the U.S.? And if it goes
Absolutely.
through, what will shipping look like in 5 to 10 years? You said absolutely. Please elaborate.
Yeah. So the other railroads in the U.S. are Burlington Northern, which is owned by Berkshire Hathaway. They may make their own bid for Norfolk Southern or decide, we're just going to go after CSX. Because if they do not merge, then they're going to be at a competitive disadvantage. Why would you want to send your freight across 2 railroads when you can send it across 1? So it just would make sense. And if there is regulatory appetite for this kind of a transaction, you could see a Berkshire Hathaway and CSX coming. And if their competitors were able to get a deal, there's no reason why you wouldn't get a deal done between the two. A lot of ifs and buts and candies and nuts, but we'll see what happens.
For an old real estate analyst like myself, today's a big day. I got to speak to 2 of my favorite railroad analysts on Wall Street. First, Tony Hatch this morning, and now Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. Again, the big M&A trade of the year so far, and certainly the biggest one. Well, firstly, one I never thought I'd see, a transatlantic, a transcontinental railroad. Union Pacific agrees to acquire Norfolk Southern, $72 billion. That's about $320 a share. That's in cash and stock. Would create North America, or the U.S.'s first transcontinental railroad. That's a pretty cool thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Isabelle, Lee, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So check us out there. Aerospace, airlines, a lot of earnings going on in that part of the world. Boeing and JetBlue today. Let's check in with George Ferguson, Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence, safely ensconced down there in Princeton, New Jersey. Hey, George, let's start with Boeing. I know, for analysts, investors for Boeing, it's all about cash flow and free cash flow and stemming the free cash flow bleed here. How did the company do this quarter?
Yeah, so the free cash flow is still a little bit negative, not much. Cash from operations positive, a little bit, 200 million, I think it was, roughly on 200 negative at free cash flow, 200 positive in cash flow, I think roughly. So we're seeing an inflection point here in cash flow. So cash flow had been negative for the last, I think it was 6 quarters before this. And I think that's just a sign of they're getting more aircraft delivered. They're going to, they've got a lot of inventory still. They'll pull off the shelf to build aircraft going forward to pull a bigger proportion of stuff off the shelf than they would during normal times, which should juice that cash flow up, pretty well. So I think it's the turnaround is still is underway. It looks like it's well in in swing. in the results we saw and the way company management commented on the end of the year. And so I think it was a pretty good results quarter for Boeing. Again, turnaround intact.
How are they addressing quality and safety issues, especially when it comes to the 737 MAX program?
Yeah, I mean, it's, as Kelly Ortberg said, it's a process. I think just the sign of seeing increased deliveries is showing us that the quality improvement at Spirit, has seen success. And they're talking about, they're at 38 737s a month now. Kelly Ortberg says he's going to approach the FAA in a short period of time and work on the 42 737s a month. So again, he must have some level of confidence that his quality and his engineering is good in order to go further. It's not perfect. They've been slowed down a little bit in the certification of 737-10 and -7. They've pushed them into 2026. I think it's okay. It's not a big move. We'd like to see them come faster because 737-10 is a large competitor to the Airbus A320, which is very successful, and one of the reasons they saw United place a big order with Airbus. But again, I think that you can't expect this stuff to go in a straight line, and the fact that they think 2026 is when they could get certification, it doesn't tell me anything's broke. It just tells me the process is non-linear, and I think to be expected in aerospace.
All right. Also, JetBlue posted a smaller than expected loss here. What's going on with JetBlue and the airline business these days? Because I know the last quarter, boy, these airline companies are really reticent to give any kind of guidance.
Yeah, I mean, a lot of them have come back with guidance, in a lot of cases lower. The airline business right now is really counting on less capacity in the second half of 2025. And we'll see how that goes. Last time I looked at domestic capacity plans for 3Q, it's kind of about zero growth. I mean, I think they need to cut capacity in the marketplace. If you look at JetBlue's results, load factor fell by, I think it was around 300 basis points, down to the low 80s from mid 80s. And they held fares pretty much flat. Yields were kind of just up a little bit. So that just tells me that there's too much capacity in this market. They just can't fill airplanes at the right price. JetBlue has other problems, like the geared turbofan keeps them from expanding. That means costs are ballooning on them. But I don't see how they'd want to expand right now, because again, what I see is a market that can't fill airplanes at the price that's going to keep them very profitable. And so someone's got to cut. And the question is who? The full service carriers are saying, hey, we got premium to subsidize us. We don't care. The low costs are going to have to. JetBlue will cut in 3Q, but every time they cut, their costs go higher per seat. So they're in a bit of a challenging position.
It does seem like the issues just compound for the companies in this space, from aircraft shortages, delivery delays, pilot shortages, wage inflation, labor negotiation, and so on. Are there differences in how Boeing and JetBlue addressing the issues, or is it really an industry-wide consensus and problem?
Well, I mean, if you talk to Boeing, everybody wants an airplane, right? And they're sold out on the 737 and 787 to the end of the decade. Everybody wants the newest. And I think what needs to happen is, again, the airlines are just putting too much capacity in the marketplace, especially in the U.S., and someone has to cry uncle and say, hey, we can't take the profitability at these levels. Park some airplanes, get them out of the business so they can right-size capacity. And I think nobody wants to do it. You have some competitors that are in a situation where some of them have already declared Chapter 11, it's like Spirit, and then refashioned themselves and got back out in the marketplace. But it's either someone's going to have to go away, or the market's going to have to get negative enough in profitability that people start to park airplanes. As we get into late end of this year, 4Q and 1Q, those are weak quarters for the U.S. airline industry. If something doesn't improve, if you've got a JetBlue that's barely positive in profitability in 2Q, without a change in this market, that's a strong negative. Near the end of the year, people will start to cut capacity and try to boost fares.
So, George, who does that? Is it one of the big three? I mean, JetBlue can't drive capacity in this industry. It's got to be one of the big three, right?
Yeah. Look, I don't think it's the big three are in a game of chicken with the low cost, right? Okay. They think that they've got pole position here and that they just keep capacity and someone's going to fail on the low cost side because the low cost doesn't have this premium seating. They might be right. Right now it looks like their profitability is hanging in there. The low cost carriers are the ones taking it on the chin.
Yep, and we saw Southwest Airlines actually now kind of start charging for bags, and now you can do seat reservations and all this stuff
Going to premium.
Yep, they didn't do before, which was part of their cachet. One could argue their brand, but they're saying, heck, we need the revenue. George, thanks so much for joining us. We appreciate that. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst. If it flies, he knows what's going on there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.